Hi everyone, welcome to another episode of the Patient World channel. We are looking at a few things today. Firstly, we are going to look at this chart which shows recent AI deals and how money is moving around in the AI/tech space. And I have to say, something on this chart makes me uncomfortable. Secondly, we are going to look at earnings. This week we have some big names reporting, and we also have 80% of my portfolio reporting earnings. I am going to go over what I'm going to be looking for in Amazon's, Google's, and S&P Global earnings this week. Thanks to everyone for the support to date. It is greatly appreciated. Like the video, subscribe to the channel, and as always, please do your own research before taking any financial decisions. Right, let's jump straight into the video with a portfolio update. The portfolio value sits at £14,374, a return of 11.21% or £1,449. My top allocation is Amazon at 36%, followed by Alphabet at 28%, S&P Global at 15%, Adobe at 11%, and the remaining 9% in Fair Isaac. Some aggregate portfolio statistics: the 3-year revenue CAGR is 11.6%, the 3-year diluted EPS CAGR is 38.6%. These companies have high margin as gross profit is 62%, operating margin is 28%, and net profit is 23%. The return on invested capital is 21%. The return on equity is also 21%. The dividend yield is small as the portfolio is geared towards growth. The trailing PE is 34 times, the forward PE 29 times, the free cash flow yield is 2.3%, the free cash flow is £19.4 billion, and net debt is £8 billion. In October, I added 2 shares of Adobe at the price of $341 and 7 shares of Amazon at the price of $215. I consider these companies to be my core positions, and I am looking forward to growing the portfolio to 6 figures and beyond. Right, let's move at the AI chart. Bloomberg reported a few weeks back on how Nvidia and OpenAI fuel the AI money machine. We have a few companies represented by a bubble based on their market capitalization or valuations. We have companies like Microsoft, OpenAI, AMD, Nvidia, Oracle, Intel, CoreWeave, Nibius, etc., etc. And we have various arrows representing a number of things. The pink arrows is hardware or software, light blue is investments, dark blue is services, and green is venture capital. The key players on this chart, as the title suggests, is Nvidia in the middle and OpenAI. Nvidia has 16 arrows pointing towards it or away from it, and OpenAI has 15. Even though Nvidia has the largest amount of deals, my issue is with OpenAI. Nvidia is a highly profitable company generating over $70 billion in free cash flow for the last 12 months, whereas OpenAI is a private company and currently is burning cash. But as we've seen over the last recent months, they are positioning themselves in the middle of this AI evolution. So let's look at the recent deals, and I'll explain why I think this is problematic for the AI space. OpenAI embarked on a massive deal-making blitz to secure the immense computing power needed for its AI ambitions, a move that created a web of financial partnerships with major players in the tech industry in 2025. This led to over $1 trillion in deals this year alone. The 3 key deals and partnerships include massive hardware and cloud compute contracts. Seeking to secure seemingly endless computing power, OpenAI has created a complex web of financing and purchasing deals with key hardware and cloud providers. Of course, we have the deal with Nvidia back in September. OpenAI announced a strategic partnership with chipmaker Nvidia. This includes a commitment from OpenAI to purchase 10 gigawatts of Nvidia's chips. In a more complex arrangement, Nvidia also signaled its intent to invest up to $100 billion into OpenAI, with OpenAI using that capital to buy Nvidia chips directly or through cloud partners like Oracle. So Nvidia is essentially investing $100 billion in OpenAI, and OpenAI is turning around buying back Nvidia chips. The most recent deal was the one with AMD. In October, AMD and OpenAI announced a strategic partnership under which OpenAI will deploy up to 6 gigawatts of AMD's GPUs over several years, beginning in 2026. As a major element of the deal, AMD issued OpenAI a warrant for up to 10% of AMD's stock, which will vest based on deployment and performance milestones. Essentially, what this deal is, AMD is selling 10% of their company to ensure that OpenAI buys and deploys their GPUs. And lastly, we have the deal with Oracle. OpenAI signed a multi-billion-dollar cloud computing contract with Oracle, reported to be a 5-year, $300 billion deal for computing power that will begin in 2027. This agreement is reportedly part of the $500 billion Stargate project announced in January with Oracle and SoftBank aimed at boosting AI infrastructure. Now don't get me wrong, all of this is great for the industry in the sense that players are coming together to build the necessary infrastructure to advance AI. However, one of the key players, which is OpenAI, is not a profitable company, so to me it feels like an experiment at best. OpenAI expects to burn $115 billion through 2029. OpenAI has sharply raised its projected cash burn through 2029 to $150 billion as it ramps up spending to power the artificial intelligence behind its popular ChatGPT chatbot. The new forecast is $80 billion higher than the company previously expected. So as this report highlights, OpenAI is burning cash and the amount of the cash they need to burn is increasing over time. At the same time, we see evidence that OpenAI ChatGPT is running into trouble. Sam Altman wants to treat adults like adults, but can OpenAI keep ChatGPT safe after opening the door to erotica? So essentially what OpenAI is doing is capturing a trend where adult users are increasingly seeking intimacy and companionship from AI. In other words, they are using these not so, let's say, ethical ways to attract and retain people. And there is evidence that their share is declining over time, which will cause more issues for OpenAI down the line. This chart shows generative AI traffic share for the various generative AI apps. Of course, OpenAI is the leader and remains the leader, but as we can see today, their market share is much lower than what it was 12 months ago. The primary beneficiary of who is stealing this market share from OpenAI is Google with Gemini. We can see that their share doubled from 12 months ago. A few months ago, the narrative was that AI is disrupting Google's business. In my opinion, as time passes, it becomes more evident that Google will be the winner. And there are a few reasons for this. Number one, as we can see, the generative AI traffic share of OpenAI is reducing over time. Essentially, when OpenAI came out with ChatGPT, it was the front runner and managed to capture the majority of the market share in that space. However, over time, Google was able to execute, sharing their own models, and are now taking market share back. Number two is that anything that OpenAI comes out with, Google can easily copy. They have the models, the talent, the infrastructure, and the resources to be able to copy any feature that OpenAI brings to the market. And number three is the fact that Alphabet is a group of businesses that are extremely profitable and can grow organically on their AI endeavors. Given that OpenAI is burning cash, it's based on external funding, it only takes a couple of bad market years for this funding to dry up. For now, and given the company is unprofitable, this is an experiment on AI. If OpenAI manages to become a profitable and free cash flow generative business, this experiment plays off. If not, all of these companies that are linked to OpenAI in some form will suffer down the line. Okay, let's move to earnings. This week we have big names reporting, which will determine how the markets do. We have Microsoft, Apple, Google, Amazon, Meta, Eli Lilly, Visa, MasterCard, ExxonMobil, AbbVie, and so on and so forth. I'll be talking about Google, which reports tomorrow after market close, Amazon, which reports on Thursday after market close, and S&P Global, which reports on Thursday before market opens. What are the key things that I'm looking for in these businesses? Amazon has $2.4 trillion market cap, and this year has done absolutely nothing. The return year to date is 1.6%, 1 year is 20%, and 5 years is 39.5% underperforming the market. As I mentioned in the past, the reason I believe Amazon underperformed the market and its peers is due to capital expenditure. This chart shows Amazon in red, Microsoft in blue, Google in orange, and Meta in purple. Over the last 5 years, Amazon consistently spent way more than its competitors in CapEx. For the last 12 months, they spent $107.7 billion, with the next higher spender spending $67 billion, which was Google. In these earnings, I'll be looking for some sort of guidance on how management is thinking of the capital expenditure over the next 12 months. In my opinion, the current capital expenditure cycle that Amazon is going through will bear fruits for shareholders down the line. The second thing that I will be looking for is how AWS is growing. The last 12 months AWS revenue was $116 billion, but as we can see, growth has slowed down from 18.5% a couple of quarters ago to 18.1% and it's below its peers. Another indication, which I'm personally more focused on, is Amazon's remaining performance obligations when it comes to AWS. Last quarter, they grew by 25.5%, accelerating growth, and stood at $195 billion. I want to see this number continue to grow, and I will be looking for some commentary around the Anthropic specific capacity that is currently being built that should help AWS reaccelerate growth. And the last two more exciting areas that I will be keeping an eye out for is robotics and Project Kyber. We had a recent report lately suggesting that secret plans reveal Amazon plot to replace 600,000 workers with robot army. As we know, Amazon is already using robots, deploying over 1 million robots at this point in time, but at the same time, they are employing 1.6 million people. However, this report is slightly misleading. Instead of eliminating 600,000 jobs, what Amazon is planning to do is essentially grow without growing the number of employees. One of the main ways Amazon plans to achieve this is by slowing hiring to a crawl, even as the company expects to sell twice as many products by 2033, according to the report. So essentially, Amazon will grow their business, but they won't hire additional employees, but instead deploy robots. Over the longer term, this should lead to margin expansion, hence greater profitability for the lower margin businesses. And lastly, we have Project Kyber. Project Kyber is Amazon's low Earth orbit satellite network aiming to deliver fast, reliable internet to customers and communities. The initial satellite constellation will include more than 3,200 spacecraft, which Amazon began deploying in April 2025. Their last mission was on the 13th of October with 24 new satellites, bringing the total to 153 satellites. Management commented in the past that services will start to be offered to customers late 2025, early 2026, so I'm looking forward to see if anything is mentioned by management over the coming earnings. Okay, let's look at estimates. Revenue is expected to be at $177.7 billion, earnings per share at $1.56, and free cash flow at $1.1 billion. Regardless of if they meet this consensus or not, to me the story is how CapEx evolves from here. If AWS reaccelerates, and for future growth, I'm looking for comments around robotics and automation and Project Kyber. Let's move to the next company, which is Alphabet. Google is currently trading at a market cap of $3.06 trillion. The year-to-date return is 37.7%, the one-year return is 60.3%, and the 5-year return is 229.3%. As we can see from this chart, from July, Google stock has been on the rise and last week hit the new all-time highs. For the upcoming earnings call, I'll be looking for AI commentary, how search business is doing, cloud growth, and Waymo. Data suggests that their generative AI efforts are bearing fruits for shareholders as their market share is expanding. We can see here that Gemini market share has doubled from 12 months ago, gaining market share from ChatGPT, and I have to say that management execution has been spot on for the last 6 months. And we also have reports that Gemini 3.0 Pro significantly improved its ability to handle text, images, and potentially audio, enabling more fluid, context-aware interactions, which is expected to be released later this year. So I want to see management continuing to execute on their AI journey and gaining market share from ChatGPT over the coming years. The next thing I want to understand is how Google's search business is holding up. Obviously, the market narrative was that AI will be disrupting this business, but I think with AI overviews and AI mode, Google is doing the right thing and is essentially safeguarding their search business. Last quarter, search grew by 11.6%, with a total revenue for the last 12 months of $208 billion. So I want to see this business to continue to grow, but I do expect growth rates to come down over time. I also want to see how Google Cloud is doing. We've seen the recent announcement with Anthropic last week. Looking at the deal, we are announcing that we plan to expand our use of Google Cloud technologies, including up to 1 million TPUs, dramatically increasing our compute resources as we continue to push the boundaries of AI research and product development. The expansion is worth tens of billions of dollars and is expected to bring well over a gigawatt of capacity online in 2026. Anthropic's choice to significantly expand its usage of TPUs reflects the strong price performance and efficiency its teams have seen with TPUs for several years. We are continuing to innovate and drive further efficiencies and increase capacity of our TPUs, building on our already mature AI accelerator portfolio, including our 7th generation TPU, Ironwood, said the CEO of Google Cloud. Last quarter, Google Cloud operating income was $2.8 billion and operating margin was around 20%. Margins should continue to expand as we know from Microsoft and AWS, but also given the recent deals and continuous business execution, Google Cloud sales should continue to grow aggressively. And this summary here from Goldman Sachs conference in September 2025 summarizes why Google Cloud will be a growth machine for Alphabet over the coming years. Google Cloud has demonstrated substantial growth, achieving an annual revenue run rate exceeding $50 billion. Cloud adoption is still in its early stages, presenting significant opportunities for enterprises to migrate, modernize, and transform their on-premise workloads. The primary catalyst for this transformation has shifted from traditional developer efficiency and cost savings to the strategic integration of artificial intelligence, expertise, and products, which Google Cloud is leveraging as a core differentiator. The company's competitive advantage stems from deep product differentiation across its AI ecosystem. This includes proprietary AI infrastructure featuring custom chips and systems optimized for high performance, cost efficiency, reliability, and power efficiency, delivering up to 2 times power efficiency and 50% performance delta compared to competitors. Google Cloud offers a leading suite of generative AI models, notably Gemini, which has garnered rapid adoption from 9 million developers and reached 1 trillion tokens 20 times faster than previous iterations. Furthermore, its historical strengths in large-scale data processing, analytics, and security are applied to ensure high-quality data input for models and robust security. This comprehensive AI strategy has enabled Google Cloud to secure 9 of the 10 leading AI labs and nearly all AI unicorns as customers. Financially, Google Cloud reported 28% sequential quarter-over-quarter growth in new customer wins during the first half of the year. Its remaining performance obligation backlog has reached $106 billion, growing faster than revenue, with over 50% projected to convert to revenue within the next 2 years. So essentially what Google is doing here is they are leveraging their full AI stack to drive Google Cloud growth, profitability, and margins. And lastly, Google is also the leader in robotaxi service with Waymo, and they plan to expand their robotaxi service in London, the first European city. Currently, Waymo is commercially available in 5 markets in the United States. London will mark the company's second international city after Tokyo, where testing began in early 2025. They have been aggressively expanding in the United States and have reported that its self-driving vehicles have logged 100 million fully autonomous miles on public roads and provided more than 10 million paid rides to passengers to date. So I'm looking forward to understand more on how management continues to expand this business segment and what their plans is for the future. In terms of consensus, revenue is expected to be at $100.04 billion, EPS at 2.28, and free cash flow at $17.3 billion. The key elements for the upcoming earnings call is how are they doing around AI, if search is being disrupted, and if cloud is growing fast enough. And the last company is S&P Global, reporting earnings on Thursday before market opens. The market cap is $147.4 billion. The year-to-date return is a negative 1.2%. The 1-year return is a negative 0.8%. And the 5-year return is 46.7%, underperforming the market in all periods. 3 topics that I'll be keeping an eye on the upcoming earnings. First of all is guidance. If guidance is in line, below, or ahead of market expectations, which will determine how the stock price reacts in the short term. But also I want to understand how their market intelligence business does over the coming years, especially given the recent news of their acquisition, which I will touch on in a bit. But also how their rating business is doing, as it's a cyclical business that is not benefiting from high yields at this point in time. Market intelligence revenue CAGR was 25%. The ratings revenue CAGR was only 5%. The commodities insights revenue CAGR was 25.4%. Indices revenue CAGR was 13.2%. And lastly, mobility revenue CAGR is 16.7%. Keep in mind that management is planning to spin off this portion of the business. So let's look at the recent deal that they've announced where they are planning to acquire With Intelligence. S&P Global agrees to acquire With Intelligence from Motive Partners for $1.8 billion, establishing its leadership in private markets intelligence. Combination unlocks new market opportunities and cements S&P Global as one of the most comprehensive providers of private market intelligence, complementing its existing expertise in ratings, benchmarks, data analytics, and workflow solutions. With Intelligence provides critical intelligence for 3,000 customers, including limited partners, general partners, and advisors across private equity, private credit, hedge funds, real estate, infrastructure, and family offices. This transaction will enhance S&P Global's offerings in private markets with $100 million of expected additional revenue in 2025, with organic annual contract value growth in the high teens. Essentially, this acquisition is enhancing S&P Global's offerings around private markets. With Intelligence's extensive data assets include coverage across the fastest growing sections of the market. They have 30K investors, including private equity, private credit, infrastructure, hedge funds, and family offices, 30K managers, 70K funds focusing on the largest funds globally, and 350K deals covered. The acquisition will deliver deeper insights, stronger connectivity, and greater transparency across the private market ecosystem, establishing S&P Global as a global leader in private markets, data, and solutions. For decades, S&P Global has brought transparency, credibility, and objective assessments of risk to the public debt markets and is focused on creating the same value in private markets. The With Intelligence acquisition will complement recent advancements across both private credit and private equity at S&P Global, including a collaboration with Cambridge Associates and Mercer to deliver comprehensive private markets performance analytics that is set to launch in beta by year-end 2025. With Intelligence, Global's team includes data scientists, analysts, reporters, and journalists, technologists, developers, and industry experts, all obsessed with revealing the bigger picture on the asset management industry. It was founded in 1998, and the integrated product portfolio of data, insights, and events has grown to cover hedge funds, private credit, private equity, real estate, and traditional asset management. They serve over 2,500 clients worldwide, from offices in Europe, North America, and Asia. Essentially, it's a pure play in private markets from S&P Global. So I'm looking forward to hearing more around this deal and how it will play into S&P Global's offerings. And in terms of expectations, revenue consensus sits at $3.83 billion, earnings per share at $4.31, and free cash flow at $1.5 billion. Obviously, the stock price didn't do great this year, but a forward free cash flow yield of 4.2% suggests a fair value for the company. That's it for this episode. I hope you enjoyed. Like the video, subscribe to the channel, and I'll see you in the next one.